When the meme stock craze started, it revolved around retailers like GameStop, Revlon, and Bed Bath & Beyond. And that's why it's so odd that software company Palantir got roped in. It's about as far from those stocks as you can get. And it's the financial pros' most searched data and analytics company on Trackstar over the last month by a mile. The next closest company doesn't even get 10% of the search volume that Palantir does. But Palantir shares are down more than 55% this year. So does that make the stock cheap? Let's take a deep dive to find out. Now, Palantir builds software and platforms for commercial organizations and governments to integrate their data, decisions, and operations at scale, utilizing artificial intelligence, machine learning, and big data analytics. The company became very popular on Reddit boards in 2021 and was part of the meme stock craze. However, unlike other meme stocks, Palantir actually has a growing business behind it. The firm doubled its revenue growth from 2019 to 2021 and is on pace to have its best year in terms of revenue. Its 12-month trailing revenues stand at $1.7 billion. In fact, according to its last quarterly earnings report, it increased revenues by 25.9% year over year. Moreover, its balance sheet doesn't look that bad at all. The firm has $2.4 billion in total cash and $256 million in total debt, reflected in a current ratio of 4.3x. But Palantir isn't profitable yet and therefore doesn't have a PE gap ratio, but it does generate positive cash flow. And despite a lack of direct competitors, it does compete with some businesses in arenas like deep analytics, machine learning, and AI. Additionally, Palantir boasts a price-to-cash flow ratio of 56.8x, which is not as strong as this quasi-peer group. It's a similar story for price-to-sales ratios too. Palantir does, however, have an impressive gross profit margin of 78.7%, but the firm's net income margin is currently minus 30.9% and its return on equity minus 24.4%. In terms of growth, Palantir's revenue growth grew at a rate of 31% year over year, which is better than all but one of its competitors. So in our opinion, this is a 6 out of 10 ranking stock. Despite shares being down 55% year to date, Palantir is still overvalued with a market cap of $17 billion. Investors aren't willing to pay a premium for growth when interest rates are rising. They're looking for companies that make money now, and Palantir isn't there yet. It's possible that the shares can rise from here, but we'd wait for the firm to show profitability first.